Exercise 9-16. We're going to apply the direct write-off method for uncollectible accounts receivable. The first thing to know about this problem is this company is using the direct write-off method. When using the direct write-off method, you do not try to estimate ahead of time how much of your accounts receivable will not be collected. You just wait until the time that you've determined someone is not going to pay you off to write it off. And when we say writing it off, and remember we're talking about accounts receivable. So if a customer we've determined they're not going to pay us, we're going to write off their account. What that means is you're going to remove the accounts receivable because they're not going to pay it off. So it's no longer an asset, does not have a future value. And you're going to record an expense in its place. So let's start here. Journalize the transactions for high-performance cell phones using the direct write-off method. Ignore cost of goods sold just to keep things simple. Of course, record debits first, and then credits, and then we're going to have an explanation. So June 1, high-performance cell phones sold $19,000 of merchandise to Andrew Trucking Company on account. Ignore cost of goods sold just to keep it simple. So Andrew Trucking Company now owes us $19,000. And we have to record a sale. So sales revenue is increasing. And we're recording sales on account. Sold goods on account. Now, normally we would have the second transaction where you would increase cost of goods sold and then lower inventory, but the authors are leaving it out just to make things simple. So at this point, Andrew Trucking Company owes us $19,000. Then about a month and a half later, Andrew paid $7,000. So cash is going up by $7,000. And we're going to lower their accounts receivable by $7,000. Collected cash on account. So now it's a couple of months later, September 5th. Remember, we're high performance. We're going to write off the accounts receivable from Andrew. So what has happened over the months is we've called Andrew Trucking Company and said, you owe us the rest. Remember, they owe us the balance. They owed us $19,000. They paid off $7,000, so they owe us $12,000. We've called them, we've sent them letters, and they still haven't paid it off. So on September 5th, we've decided they're not going to pay it off. So at that time, we have to remove the amount that they owe. So let's go back up here. So remember, they owed us $19,000. They paid off $7,000. So at this point in time, they still owe us $12,000. Well, we've decided that they are not going to pay us off. So we have to remove that accounts receivable from our books because accounts receivable is an asset. And by definition of an asset has a future value. If that person is never going to pay you off, that does not have a future value. So I have to remove that AR. So to remove AR, that's going to be the credit. So I'm skipping the debit. Remember, debits go first. So I'm removing the AR for Andrew Trucking Company. So now we have to record an expense, and expenses go up with a debit, and that expense is called bad debt expense. And this is called writing off an uncollectible account. So we've deemed Andrew Trucking Company as an uncollectible account. We remove the AR, and we record bad debts expense. So that was back on September 5th. So on March 5th of the next year, High Performance received Andrew's check for that $12,000 they never paid us with a note apologizing for the late payment. So the process for reinstituting the AR is we have to go back to the transaction where we wrote it off, and we're going to reverse it. So we're going to reverse it. We're going to increase AR to $12,000. We're going to remove or lower the bad debts expense. And so this is called reinstating a previously written off account. So now, according to our books, they owe us $12,000 again. And now we can record cash of $12,000. And then we remove that AR again. And this is called collecting cash on account. So now you might be wondering, well, why did we reinstitute this AR only to remove it again immediately? Notice these are both on the same day. Well, the reason we do that is just so that if we ever look into the AR account for Andrew Trucking, we show that they did have this $12,000 balance and they did eventually pay it off. Requirement 2, what are some limitations that high performance will encounter when using the direct write-off method? Well, if you think back, we had earlier in this book, we learned about the matching principle. Now, what the matching principle means is that in the same time period, you need to match the expenses with the revenues that they helped generate. So by using this direct write-off method, we're technically violating the matching principle. So I'll show you what I'm talking about. So back up here, in June, we recorded revenue. And then we didn't record the bad debt expense till a couple months later. So if this company is doing their books monthly, we've got revenue up here in June that did not have its matching expense, bad debt expense, recorded until a couple months later. If the company had instead used the allowance method, which we will learn later, they could have avoided this violation of the matching principle. And one more thing, remember the only companies that are allowed to use this direct write-off method are small companies and companies that are not publicly traded. Remember, publicly traded means they have a stock on an American stock exchange. So if a company is publicly traded, they are not allowed to use this direct write-off method because technically it violates the matching principle. And that's it.